And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal. The full story. Real talk about money, markets, life. Now, it's The Real Investment Show, presented by RIA Advisors.
Happy Halloween. Yes, we are doing this on 10/31, but we won't scare you. Well, we might scare you.
I was expecting you to be in costume, Rich.
That's tonight. My gosh. Welcome to Financial Fitness Podcast. We appreciate you being here today. Thank you, Jonathan McCarty.
My pleasure.
For spending some time with us. So, baby's first Halloween.
Yes. We're excited.
Yeah. It's fun.
Yeah. He's too young to trick or treat, but we're going to dress him up and walk around the neighborhood.
But see, that's the thing.
Yeah.
You dress him up. So I have videos of my daughter when we first dressed her up as a pumpkin. Mm-hmm. And have her walking around and just showing her all the stuff. And she's like, like she had no... Yeah, but it's fun for you.
It is.
It is.
Yep.
Yeah, it's fun. Yeah. Well, we appreciate that. Everybody be safe. I mean, it is like the scene of universal horror as far as like the number of kids. I mean, hundreds of kids. 10 years, there were no kids. Now it's hundreds of kids. And these trailers that come down the road that carry all these kids on the back of them.
Really?
Right? With all these Halloween scenes, like lights and monsters, and then the guy who dresses as Leatherface, and he walks down the street with his fake chainsaw over his head. It is the funniest thing, man. Halloween in my neighborhood used to go from all these old people, and I guess they died off, right? So now we have all these new families moving in. It has become absolutely, it's out of control.
That sounds pretty awesome.
It is actually,
Yeah.
it's a lot. I mean, I was like, last year, I was like, holy crap, this is like amazing. Everybody dressed and all that. So, but we won't scare you today with finance, but finance can be scary. Especially when it comes to risk tolerance questionnaires. Whoa, no.
The R word.
Let me just explain. This is possibly the poorest, dumbest areas of finance. You have all, or most of you have filled out a risk tolerance questionnaire. And when you go through them, and I'm sure, Jonathan, you've gone through a lot.
Mm-hmm. One or two.
Yeah. You sort of could laugh at them because how much of a failure they are to predict how you're going to act in certain conditions. And all it is, for the most part, is a way for compliance departments to cover their asses, right? There is nothing that is going to help an advisor or you, because it all depends how you feel that day and what the market's doing that day. Oh, it's a sunny day. The market's up 200 points. Man, woof. Yeah, market falls. I'll buy more. I'm going to buy more. I mean, and then obviously, if the market's down, you're answering that damn thing differently, right? So when it comes to real markets, they absolutely fail. So give you some of the way we make the sausage around here. We use something a little bit different, sort of a psychometric way of looking at things through a company called Data Points. And we have all our prospective clients go through the investor profile because it's really looking at greater decisions outside of your investments as far as measuring your risk aptitude and attitude, right? How willing you are to take on investment risk. Mm-hmm. And there's one, we look at risk capacity. So that's your overall situational ability and financial to take on the risk. Obviously, the standard stuff, time horizon, principal and income from investments, and then also risk attitude. Just your overall attitude to take on investment-related risk. Years ago, I started studying how risk tolerances were a big failure and just a big proponent for the compliance department. But there used to be one that used to be Phenometrica, and we used to use that, and I noticed it hadn't changed much. And I wanted something more dynamic for us. So we gave everybody this. So I took it. I think you took yours.
I did take it as well.
So this investor profile test that we give everybody, it can help you, it helps your advisor understand your personality and experiences with making investment decisions across the board. Also, insight on how you can anticipate, one, how you will make decisions, and some of those emotional bias pitfalls that you might fall into. Mm-hmm. So I don't know about you, but I have a feeling I know where you came in on a lot of this stuff.
I think the creators of this test were in cahoots with my wife.
You think so?
Yes, because the first category is investing confidence, and the feedback I got was that I can possibly be overly confident. And
but here's the thing, and it's a great point you're bringing up. I got a score of 99 on my investor profile overall score, right? So that's the measure of your psychological risk tolerance, right? Made of 5 characteristics. You have an above average, and you think about, and obviously I got may buy during a downturn, 90 on that. So the one thing as advisors us taking this, what overall score, investor profile overall score did you get?
My overall score was a 99.
Me too.
Yeah.
Do you think that's because we're advisors?
Funny that my may buy on a downturn was also a 90.
Was it?
Yeah, I think we had almost the exact same score, Rich. Although the other aspect, that, again, in cahoots with my wife here, my judgment was a 10. So
I wonder if they have a spouse tolerance questionnaire. Is that
would be good.
I wonder where everybody would fall on the spouse tolerance. Why don't they do that before you get married? Give you all a spouse tolerance questionnaire.
If you're smart, you've had those conversations.
They do.
They have a test?
It's called premarital counseling.
Yes,
but they actually
that
give
is true
you
through the church.
They actually give you a test?
I've not seen a written test. Have you?
No, it's more of a
I
conversation.
got to talk to Sarah Fallow at Data Points to
Yeah.
do a spousal.
There's an opportunity.
He scored 99, but he's way overconfident.
Yes. Sounds so familiar.
Now, I did get risk perception, because risk perception in this questionnaire gives you an idea of what you're feeling about markets right now. I did get a 55. So I got it a neutral. I'm not negative or positive, right? Because of where the market's done. Knowing it probably could go more. So it's based on the market, the economy, the market, and your overall financial position. So I was pretty meh on...
Kind of middle of the road.
Yeah.
You're kind of a pessimistic guy, Rich. I could see that.
I know, yeah. Really am.
I came in at an 80, so
that's
I'm
good.
pretty positive.
Yeah, you are
but
pretty positive.
Again, most of my
But life
trading
hasn't really
strategies-
beaten the shit out of you yet.
Not quite
it's
yet.
coming.
It's catching up to the last 5 months. Are definitely
No, I'm
doing
telling you,
their
I
work.
know. I can see the difference. Like, you've been pounded.
You
but
see the bags?
Yeah,
guys?
no,
You do? Yeah.
I could pack for Africa in those bags.
I don't know how
So
these dads do it. I don't know.
Oh,
It's rough.
wait till you see him a year from now and he's got that big hump on his back.
Yeah.
And no hair.
And no hair.
Oh, great. It's coming, huh, guys?
Where did Jonathan go?
A shell of my former self.
That's what- Really, there's something lovely about children, but there's also something soul-sucking about it. It's a double-edged sword.
But the greatest gift in life.
It is. Listen. I have to say, I always wanted just one child, and I wanted a girl, and I was graced with that. And I thought being a dad when she was little was the best thing in the world. Like, amazing. All the things that you get to show your kids that you liked and take them, and, they like you.
Yeah.
They like
You're the
you up
hero.
until around age 11, 12. And then they don't like you till they're 30. And by then you're, crapping in a diaper and they don't want to know you anymore unless you go, is there an inheritance?
The biggest boost of confidence is just getting that giant grin on my kid's face every time I see him. That is just like right to the heart.
I mean, there's nothing like it. And people who don't have kids don't realize that, right? I know now we're switching into some sort of other conversation. But
Are we on Maury now? What's going on here?
we're
Rich?
more. Who was that? Are you the father?
Yeah, that's Maury.
That was the best part of
I declined that invitation.
Yeah. So you have to understand, if you're working with a brokerage firm, most likely doing a standard risk tolerance questionnaire, and they're basing their investment decisions on that, which means when the hits the fan, and I'm talking about not only when markets are turbulent and heading down, but also in the environment we're in right now, I become more skeptical as we move forward.
Yeah.
Because of the complacency, and Lance has written a lot about this, right? So when we look at these metrics, we get investing confidence, volatility, composure, risk personality, risk preference, judgment, and action. So what I also learned from this, 99 on investor confidence, volatility, composure, only got 70. I'm somewhat composed. Risk personality, seeking risk preference, somewhat high, judgment, more balanced focus, action, may buy during a downturn. Now, could be also, you think about age differences, right? And also studying of history, that balanced portfolios over the long term probably give you around the same return as a 100% stock portfolio with less volatility. I know that looks stupid over the last 3 years because we're in the middle of this romance with AI. But outside of, when you look at normal returns, we explain the more risk you're taking at these levels of valuation doesn't mean you're going to get more return. You could in the short term, but you might give it up in the long term. When you look at these numbers, this is very good for your advisor to get an understanding of what you might do, which is why it's a great tool for advisors to look at this. And especially when you look at when spouses do these, a husband does them and a wife, and you see the conflict in the numbers. So what I do is generally address the conflict in the numbers, or at least I'm aware of it to know who's going to be more level-headed during a downturn, more tempered, who's going to be all gangbusters one direction or the other, sell everything or buy everything.
Yeah. Well, on the note of a husband and wife, if they have a joint account, we have to kind of find a balance between their two risk profiles.
Right. And I will say this, and Professor Terry Odine, old professor out of Berkeley, was the best that said women are better investors. Women look at overall risk. Men get tied up in ego and decision. Like I had one client that would not let this one stock go.
It's going to come back.
It's been 10 years right now. He's waiting 10 years, right? The opportunity, it doesn't matter, right? He made that decision where she's been more practical. Say, listen, why don't you just sell it, take the loss, and then if you like it again, we'll buy it back in 31 days. I mean, I have noticed women on these questionnaires are definitely more tempered.
I would agree.
So that's definitely good. So when I look at scores, I always look at my own score and other people's scores if they're extreme one direction or another. You brought it up. 99 confident, which means that I am overconfident. And if you are working in this industry, you think you know more than you do. And you have to understand the stock market will take you to your knees faster than Michael Corleone.
Take you down.
In The Godfather. Yeah. Yep. I mean, you're down there, right? Because markets will do exactly the opposite of what you think. So when you see a score is like 99, I try to address those scores by saying, we got to understand why you're so overconfident and don't be that, right? Like my grandma would say, don't be such a smart ass. How to get the ass in there. So you have to look at these as much more of a multidimensional way of looking at risk. And there are not many ways to do that because, again, we don't see a lot of innovation in this risk tolerance questionnaire space. So what happens is it leaves your advisor up to in uncharted territory when big events come. And I'm talking about now when there's so much complacency and people who are generally less confident, less composed on these scores are calling me and want to now go in 100% into equities. And then I go back and look at their investor profile going, I know what this is. This is danger.
Yeah. Yeah. Fear of missing out. Now they want to get in.
Now they want to get in, right? And as advisors, we have to, along with you, to be open to, we have to help you understand where your weaknesses are. And if this turns down, your reaction to it will ultimately cost you money.
Yep.
So that's the beauty of having a more multi-faceted way of looking at risk. So, seeking balance, seeking risk. My score was 80 as far as, overall risk personality, opening to different types of investments, where if you come in lower on this risk personality, you're going to stick to more traditional types of investments. And that makes sense. I mean, I own Bitcoin and I own some things, but I'm not totally off the scale. I'm about 80. What did you get on that risk person?
I got a 99.
Yes.
Yeah.
I got to talk to
But
Mrs.
again,
McCarty. Overconfident.
I also, the reason my judgment was a 10 as well, just so I could adjust the poor judgment that I appear to have, is that it's a short-term focus. And I like to trade derivative products, which by nature are inherently the most risky option out there. And generally speaking, short-term focus, unless you're looking at things like leaps. But, that reflects my investing style, which is not for everybody. I will definitely admit.
But it does show your overall capacity to take it.
It does, yes.
And again, this 99 doesn't mean that you're overconfident. It means that your personality has more bandwidth.
I appreciate that, Rich, but I am also occasionally overconfident.
No, me too. Yeah. No, but at least but here's the thing. You recognize it.
I do. I especially
recognize
a
lot of people are in denial, and not that river in Egypt.
Yeah.
Right?
I usually recognize it when I'm losing on an option trade and see that big loss, and that knocks me down a peg.
Yeah, it's like Negan on The Walking Dead with the bat. He's going to come and hit you in the head. I mean, the market is that way, but your capacity to because of your experience. So if I have a client that has certain amounts of money and they come in higher on these scores, I could recommend one of our different portfolios. Like, Are you? It seems like you might be comfortable with options and other kinds of stuff. Oh yeah. Oh yeah. Okay. So these types of deeper conversations and questionnaires can help you move fit the portfolio to the client better.
That's right.
Right. Not any gaps in it. Like when you buy Legos from Temu, right? They don't really fit, but they're sort of fit.
And it just says ego on there.
Yeah, there's just a gap,
Drop the
and
L's.
it's an ego. Yeah. So then there's judgment, right? And you look at our orientation or our approach. It assesses whether we focus more on the short-term or long-term benefits of markets. And I always believe you have a little bit of both.
Yeah.
There are people... And I'm sort of one of these that if something gets squashed and I don't think it's worth it, I'll take more risk on it, like a Palantir or something else, right? And we've done that at the firm, right? During the investment meetings, we'll say, well, this thing has just gotten beaten up unjustifiably. We need to add it because nothing's really, changed. So the longer term focus or the shorter term focus, we could talk about. I want to know what number 90 you got in this one. There's problems with either the very short term focus or the very long term. I came in with 60, which is balanced. And let me just guess where Jonathan came in.
I came in at a 10, which is the shortest term focus out there. Again, derivative products expire weekly, monthly. It is a short-term focus.
He doesn't look into his marriage like this.
Yeah, well, thankfully my investment account is separate from what my wife can see. So
you know what I'm going to say? Here's Mrs. McCarty. Yeah, short-term focus. I remember the honeymoon.
Yeah.
Pretty short-term.
Bum. That was a low blow, Rich.
This is where I get Brent.
I'm not mentally sharp enough today to
Brent
have a
shaking
comeback
his
for
head
that.
and hiding under the console.
But no, I mean, you're right, Rich. The balance is between long-term and short-term. And I think this is also illustrated in the two main investment disciplines, which is fundamental analysis and technical analysis.
Right.
And we use both of those in our portfolio management strategy. The fundamental analysis is more geared towards our long-term views on companies. And the technical analysis is more geared towards our short-term focus on where the individual security may be headed in the next few weeks to few months. Yep. So, again, going back to my investment strategy and style, it's not surprising that I came in at
Yes.
a 10 because I'm trading short expiration derivatives.
So let me ask you a question. As you go through these different ones, and we'll go through, are you doing some soul searching along the way?
The
With
overconfidence one hit
baby
me
and
a
all
little
the-
bit.
are
Yeah, I'm
you
not gonna
like-
lie.
okay.
That one stung a little. Yeah. But no, it actually described me very accurately.
Mm-hmm.
You know, I do occasionally feel a certain level of conviction on trades, and sometimes that works out in my favor, and sometimes it doesn't. But
Mm-hmm.
it also, just like you said, Rich, can knock you down a peg when you get a little too confident.
Mm-hmm.
That's the risk with some of those index expiry options.
Oh, yeah.
Is that they're cash settled, they're same day. I mean, you can go further out, but you can also trade same day, 0 DTEs, and they're very
I
lucrative.
think those things are crazy.
It's absolutely gambling. It's
You
absolutely
are just
gambling.
absolute. There's nothing behind that except making a gamble on, and sometimes that'll work because there's a tailwind to markets.
Right.
We understand that, and you can possibly, but you got to pick the day,
Well-
and that,
Yeah, go ahead.
yeah, especially like when the Fed's coming out.
I was just gonna say, yeah,
Go
this
ahead.
this week the Fed came out and made an announcement, and Fed announcement days are great days to trade 0 DTEs if you have that risk appetite. Not financial advice, right? But yeah, I'm a big fan of trading the calendar.
Wow, look at this guy.
I mean, I'm not saying that good at it. If I was, I don't know that I'd be standing here, Rich. But I'm having fun.
Jonathan would be the kind of client where we go, perhaps we're not the right fit for you. Perhaps. So I was on 740 KTRH doing an interview about the Fed before the Fed came out, and I said, well, I think the Fed's like in a fog right now, and there is no assurance that they'll have a rate cut in December. And then one of the guys called me and said, did Powell talk to you? No. It's just that easy to figure out them.
Yeah.
Because they are not that, whatever they are. So next is action. So now you look at, you're in this financial chaos, the next market storm, the next market complacency move, and you go, what's this? How are you going to respond when the stock market or other investments decline? So this is based on, say, your past experience and preferences and actions that have been shown to, how are you to statistically take action during a market downturn? Now, I got a 90, and I know what you got.
I got a 90 as well.
Oh, you did?
I did, yeah. I was somewhat composed on this category. Yes. But, you be fearful when others are greedy and greedy when others are fearful. So, yeah, if markets are down, I'm looking for buying opportunities.
Absolutely. And so this is also good for your advisor to know, because this one, to me, is ground zero for conversation.
Oh, yeah.
Because if I have someone that's going to be on the may sell, then I have to do something. I might have to notch down the portfolio a bit, or have a real heart-to-heart with this person that what percentage of stocks you're going to feel, because you're going to sell at the very wrong time.
Yes.
No, I'm not. No, I'm not. Yeah, you are.
Every time.
Yeah, you're going to do it. So if that's how you're going to react, we have to start you out with a lower allocation, smaller allocation to stocks, because you just might not hold, and that is going to obliterate your returns, right?
Correct.
So this one to me is sort of the heart. So when I'll look through people's investor profiles, I go right down to the action first, because I want to see how they feel overall. And I think that that's important. So I got a mapped portfolio. So this will give you an idea of the kind of portfolio I feel comfortable with. Moderate, 55 to 75% stocks. And frankly, that's sort of where I am. I'm about 75% in stocks. Let me ask Jonathan where he came in on this mapped portfolio.
I came in mapped in as high, obviously, yes. Stocks 65 to 85. So about 75-25 is what it indicated, which actually is a low for me. I don't hold any fixed income.
Yeah, you don't want any of that crap.
I'm too young for that stuff.
Yeah, you're too young.
That's more Rich's speed.
Yeah. That is. That is. I don't like. I mean, listen, we're gonna bring up powder keg here, and Lance is gonna hit us on the head. There's nothing wrong with having some of your portion of your money in fixed income, especially as yields fall on cash.
Oh,
right?
absolutely.
Listen, you're not going back to zero in cash, but obviously, when the Fed lowered rates, I got this tirade of emails about how the rates are dropping on this, and this, right? So if you do want bonds, you still can get even callable bonds,
Yep.
federal home loans, so that are still paying close to 5%,
Yep.
right? The best thing that you could possibly do is possibly ladder out a little bit longer term than you have, because we know one thing: when Powell is out in
Rates
May,
are coming down.
yeah.
Yeah.
Not only we'll have to see if I'm right, so we're going to have to remember this. If they want the intermediate long-term end of the curve to come down, they're going to have to go back to quantitative easing, even though they don't want it.
Yep.
And
Correct.
I very well can see Scott Bessent pushing for that. Right?
Yep.
He's very happy that the 10-year went below 4%. He was like a giddy kid on news, like on CNBC and Fox Business. He was like, yep, see. So they are going to manipulate that yield curve. And then the connection between the White House and the Fed has never been so muddied.
Yeah.
I think that's what we're going to see overall. So just the fact that they want these lower rates and they're probably going to push them. If I had a significant amount of my money in fixed income, I would want a little bit more intermediate, longer end of the curve, except for things that I need in the short term for cash flow or create a retirement income, right? I'm going to have much more shorter money in the bucket.
That's right.
So,
Well, it also depends on your stage in life. I'm, although feeling older every day, still in my 30s, young accumulator.
holy crap.
So, yeah. I know. Yeah, 30s, guys.
I thought he was 52.
Yeah, the baby's aging me. But no, I'm still a reasonably young guy. So, yeah, I don't feel as much of a concern to have that stability in my portfolio. But for somebody, in your demographic, Rich, it would be important.
Hey.
I just said demographic.
I got 75%
come on,
in
yeah.
stocks. I'm not that far behind you.
No, not at all. But
Because I think stocks are perpetual to me. Like I feel comfortable with stocks.
Mm-hmm.
Like I have this little bond money, but I feel more comfortable with individual stocks.
Well,
and
you
frankly,
have-
I don't even like bonds. You know what I like? You're
What's
gonna
that?
laugh. Fixed indexed annuities.
Really?
Yeah. So
That's
I own.
surprising. Okay.
I own about 4 of those. Because here's why: I use them as bond replacements.
Yeah.
Because I'm going to get a percentage of the S&P. I have no downside. At least with bonds, I even have downside.
Yeah. Correct.
But I can capture some of the upside. So I ladder those.
Mm-hmm.
And there are studies from Ibbotson that shows that depending on the environment, that's actually a good idea.
Yeah.
So I look at fixed indexed annuities as the bond portion, and then I like individual stocks. I'm not a big fan of ETFs, so I like individual stocks.
Same.
And I like doing the homework, and I'm comfortable when they come down, adding if I need to. And I also have a sell discipline that's based on ours, where, you got to have rules.
Yeah. Yeah. Well,
You got to have rules.
you also have decades of experience in the industry, so of course you're very comfortable with equities. But I think that most people, in your situation, may not.
That stock market crash at 29 I almost jumped out of a window. I was little then,
We're
but
glad you stepped back. Yeah.
yeah.
But yeah, I mean that's understandable.
Yeah, I invested for Hal Roach, and then he created the Little Rascals.
Were you Spanky?
Yeah, I would have loved to have been Spanky, let me tell you. I would bring back that show in a minute. I always send Brent clips. He ignores me, but I always send him the Little Rascals clips.
He's laughing on the inside.
They are funny as hell. I mean, I don't know what was going on there, but
I think part of the charm of that show is the lack of technical expertise.
absolutely.
And,
When they
and
move from one room to the other, it's
Yeah.
like it's gone. The screen goes black, and then they're in the other room.
Nice, good transition.
Yes. Oh, yeah.
Very smooth.
Yeah, like the Grand Canyon, jumping
great
over
editing.
that. But it is funny. But the point I am making to you, we are making, is these risk tolerance questionnaires that you get is not really going to reflect how you act at certain periods, which means that your advisor loses more hair and you get upset with your advisor, but the compliance department at the firm is real happy. So this is an area that needs absolutely further analysis and creation. I think we've got one of the most cutting edge tools to do it if we use it properly and really get into the dynamics, especially on the outliers. If you wanted to skip over the moderate numbers, that's fine. But when you see like what we have are some of those overconfident, right, these kinds of numbers, you want to tackle those and get further insight.
Yeah, and I often see that it's the opposite end of the spectrum for a lot of people. They consider themselves risky investors. You know, we're having conversations. Oh yeah, I'm very risky. I'm comfortable with risk. I take a lot of risk in my portfolio. And then how many times do you get the risk profile questionnaire back from that client, Rich? And it's incredibly conservative.
Exactly.
And they start looking at the actual numbers. And when you start putting numbers with it and saying, okay, you could lose 25% of your portfolio in 1 year, how would you feel about that? And people start holding their chest, you know, but otherwise they tell you they're a risky investor. So, you know, it helps us to have those conversations around what really is suitable based off of some hard data that we can reference.
And I'm going to say, just knowing myself so well, back in the 20s when I first took these tests, I was still more of a balanced, focused, buy low, because I've been studying markets since I'm like 13 years old. I was just fascinated with markets. I always thought that, I've been told the story ad nauseum. I had my uncle who just retired as a broker. He was like 82 years old as a broker. And he's going, oh. And he's like, he's from New Jersey, right? So it's like, this retirement thing is crazy. I hate this retirement. This, that. Yeah, I can't use the words he's used, but he's like Joe Pesci, man. Yeah. I mean, like every other word. Boop, 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 boop. I got to stay home now? This is crazy. 82 years old. I mean, and I said, yeah, buy some McDonald's stock because, you know, I heard this whole thing on Louis Rukeyser or something that, you know, you're an owner. Like, you know, and I was sort of a, you know, chubby kid. I had the man boobs and all that.
Love some Mickey D's.
Oh, yeah. And McDonald's was just moving into Brooklyn because McDonald's would always be in a suburb. You always knew you were hitting areas that had more space when you hit a McDonald's because they would never go into the urban areas. And then they started like mid to late 70s moving into more of the urban areas. Like I've never seen them in a city before that. Like we had to go drive 2 hours and then go, oh, look at that, a Burger King. Oh, look at that. You know, it was like a novelty.
It's like trying to find an In-N-Out here in Texas.
In this part of Texas, anyway. Yeah. There is one in Houston, isn't there now? Or no?
Willowbrook.
There's one in Willowbrook?
Yeah.
Oh, they won't be there long. They must be getting robbed left and right.
My wife has a nameplate on a parking spot.
Oh, she does?
Oh, yeah. She loves them.
It's great food.
Is it?
It's all about the presentation, too.
I'm an In-N-Out over Whataburger guy, and I get in arguments with my friends about this.
In-N-Out looks better than Whataburger to me.
Yeah. It hands down is.
Ever since Whataburger went corporate.
Well, we know they went to private equity. So.
Greasy, you know?
Presentation is not good.
Mm-hmm. But my favorite, and still my favorite, and I'm sorry, because when I was growing up in New York, and you were out all night, and you got home at 2 a.m., the first place you hit was White Castle.
Okay.
And I still like those little slider burger things. Although I found out I used to eat 30. I can't eat 30 anymore because terrible things happen. That happened one weekend, and I'm like, I told my girlfriend Amy, I'm like, I don't think I can see you this weekend because I'm just living in the bathroom right
The meat sweats?
Yeah.
You get those? Yeah.
Oh, my God. It's, you know. But the most important part, even when I was younger, so when I went and I had my uncle buy me these shares, so then I walked into the local McDonald's and I ordered $200 worth of food.
Well, yeah, you got to pad your dividends.
1977. Yeah. Right. I'm 13 years old, 12 years old, and I'm ordering and the guy, the manager comes out and goes, you know, $200 worth of McDonald's back then?
That's one of everything on the menu twice?
Twice of everything on the menu.
Right.
How are you paying for this? I'm like, what? I'm paying for this? I'm an owner.
Oh, man. That is hilarious.
And he's like, son, I need to talk to you.
That's not the way this works. Yeah.
But let me tell you about this guy. He sits me down. I'm all excited because I'm going to get $200. I'm going to be like Wimpy on Popeye. Like I'm going to eat burgers right? And
Hey, you Tuesday.
Yeah. Like this will last me a few Tuesdays. Because I was thinking about ways on how do I store these burgers so they last 2 months? Little do we know that you just leave them out and they'll last 25,000 years, right? He goes, listen, son, I understand what you did. I think it's great, you know, but doesn't work that way. Like if you pay for the burger, it helps your share price because that's money and revenue and all that. I'm like, oh, well, that totally blows this whole investing thing for me out of the water. I don't. But he did teach me a lesson, and he did give me a free meal.
That's nice of him.
Yeah, because he thought it was nice that such a young kid had a McDonald stock and was interested in being an
interested in
owner, but
investing.
I walked out of there disappointed as hell. I cried in my Shamrock Shake like nobody else.
Go yell at your uncle.
No. Well, he never told me that. I picked that up from reading, and that, how can a poor kid from Brooklyn own McDonald's? Like that didn't compute. But the fact that you were in a country that you could do that blew me out of the water. I mean, we were on welfare, right? I had to use food stamps to get my mother's tampon pads, and that was not happy days for me. Okay, especially when need a price on Kotex on the mic,
It's a
right?
heavy flow day.
Yeah, and I'm standing there with these food stamps, going, I want to die. I just want to die. And this is true story.
Oh man.
In the old days, food stamps, I know we're going through this whole EBT now, but in the old days, you could use food stamps for a lot of stuff if they knew you, like beer. I mean, a lot of crazy things. And I was just embarrassed. So I'm like, here's where I can actually be an owner. And again, the spirit of it's right? Because I even taught my daughter, and I teach young kids that you are an owner. That does change how you feel. Say for a company, Amy's son, Tommy, he wanted to create a stock portfolio. I matched him. He had 200. I gave him 200. He picked the companies, why he picked them. Because you got to feel like a sense of ownership in what you own.
That's right.
Right?
Skin in the game.
Skin in the game. So, but it's not owner the way you think. So
It's not free meals owner.
I have always had, yeah. You can understand how I came to that conclusion, though, right?
Oh, of course, especially as a child. That seems only reasonable. Yeah.
Imagine,
Especially as a big child who liked to eat.
yeah. Imagine if you'd bought General Motors.
Yeah.
I could have.
I'll take my new Cadillac, please. Yeah.
Listen, we had one of those Cadillacs, and all I did was sit in the back and slide from one side to the other. I mean, I was bruised after a ride, okay? No.
Oh, man.
I didn't want that. But the most important thing with these questionnaires is I would say, if you took this at 20 as well as 50, as you are now, mentally, some of the numbers probably haven't really changed for you very much. Because I think some of who we are from a risk-taking perspective comes early on.
Oh, yeah. Formative years.
Right.
Yep.
I have learned to take more risk, but I was never really a big risk taker. But when I learned about stocks and started reading them, I realized, but I always kept a more balanced approach. Like if I owned a pretty aggressive stock, I would also own a boring stock. Like sort of like how we balance our portfolios, right? We're in the growth area, we're in the AI, we're in the infrastructure, but we also have some dividend and value stocks to circle around it because we know sector rotations could be fierce.
That's right.
So I've done that. But the most important thing for you to take from this conversation is don't walk into McDonald's saying you own stock and try to order $5,000 worth of food. That's not going to work. But you have to look at, if you're with an advisor or broker that's using a standard questionnaire, you have to realize that you might have to dig deeper on your own or work with your financial advisor to really put yourself in the place of the market's down 20%. What are you going to do? Because that's very tough to put yourself in that kind of situation when markets are doing what they're doing right now.
Yeah, I mean, speaking in hypotheticals is very easy, but when you're actually experiencing that feeling, when you have to pull yourself out of that emotional roller coaster, that is a very challenging thing to do.
Right.
Yeah.
Exactly. So like, yesterday Meta gets slammed. I own Meta. I was like, you know what? Toward the end of the day, I added a little more to it, right? Because I read everything and went through it. That doesn't mean I'm right. Doesn't mean I'm overconfident because I'm taking a risk, and I get that because there could be further selling. The most important part for me is this kind of a questionnaire that's multifaceted has really helped me understand, or at least validate. Like you said, you validated a lot of things, but that doesn't mean that's good. So I always look at the lowest score. For me, investing confidence was 99, and we're coming to the end of this here. 99. Which means that I have the tendency, I think, to be overconfident, and I've got to take that into account. And then my judgment is a balance focus, which is 60, but somewhere along the line, I'm not investing along that more line. I'm more aggressive than that balanced approach. So I'll always, when I look at these reports, when they're run for clients, of ours, and I'll go through randomly. I always look at the outliers. The other stuff in the middle, not too worried about. And I always look at the outliers, and I think that that's the way you have to look at it. But if you're working with a broker and you don't have access to this, you have to work with your advisor to really have that conversation.
That's right.
You know, because your advisor, most advisors in studies show are overconfident. We think we know everything, and we don't really.
Again, in cahoots with my wife. I don't know where this came from.
Oh, Amy says that too. Yeah, my girlfriend goes, you really don't know everything. I'm like, no, I don't. And I got to get better at that.
I tell my wife, look, I'm not always right, but I'm never wrong. It's usually the nights I sleep on the couch.
Did you put the baby on your chest? It feels good. Yeah. So again, the lesson here is risk tolerance questionnaires that you're getting for the most part do not work, because it depends that if it's sunny out or it's cloudy, and you got to dig deeper. If you go to datapoints.com, there are various tests you could take for free. That will help you through that. And again, it was created by Sarah Powell. Her dad wrote Millionaire Next Door. She wrote The Millionaire Next Door Part 2. And I think when I first read Millionaire Next Door, I realized what a valuable book that is.
Oh, yeah.
If you have new graduates, or now the holidays are coming, and you want to give your young adult children or grandchildren a book to read, that is absolutely, whether it's the new one by Sarah or the one by her dad, that's the book for
Couldn't
them
agree
to
more.
read.
I actually did not know that there was a second one, but I do plan to read that now. But yeah, I loved The Millionaire Next Door. It was one that was given to me shortly after graduating college and made a significant difference.
Oh, that's great.
Yeah.
That's great.
I had a lot of friends, you know, we used to call them the $50,000 millionaires, you know, because you'd get out of college and get your first job. And then, of course, the first thing that most of my friends did was go and buy a fancy, expensive car. Yeah. So it really put things into perspective.
I know I said this before. When I started at JT Moran, which, again, is in the movie Boiler Room. If you haven't seen that, it's really a good movie with Vin Diesel. Vin Diesel played my boss in that film. But I drive in a Dodge, and I look around, and every car is like a BMW, but none of them paid for. Not one.
Leverage to the hilt.
Leverage to the hilt. So the most important thing for you is understanding that this kind of market, this is where the risk tolerance questionnaire, or at least doing some soul searching on your risk capacity, makes a lot of sense. Because when markets go up like this is when I worry more.
Yeah. Yep.
When markets go down, of course, it's concerning. But as I always told Lance, and I know Lance since 2006, is the sell discipline helps me sleep at night for the clients. Having some form of rules to exit is very important. I'm not a big passive guy. It's better buy and watch. And I think that's the philosophy we created here.
Yeah. And definable metrics, not
and
just,
definable,
I don't feel good about this anymore.
Yeah, my gut's telling me not to do this.
Exactly.
But on the upside like this, it concerns me more, because you suck in people that when you look at these numbers, you know they're going to make the absolutely wrong decision. And your
at the worst time.
Your advisor needs to anticipate the storm and help you understand how you're probably going to react. And that person's going to say to you, and I had this happen, I would not. And besides, this AI thing, this is going to be for like forever. I said it could. Listen, AI is part of our lives, but guess what? Sooner or later, it's just part of the day.
It's just every day.
I will show you, and I have magazines of Wall Street, originals from the early 1900s through 1942. Huge stack of magazines. I read those articles from the day because what I want to see is what were people saying during the Depression? How were people acting? Right? And there's a couple of issues on radio stocks. Like when radio first got in, I got a couple of issues that went through how this was like amazing. So there was this small group, like RCA Victor and all these, right? But there were others. These stocks were up like AI stocks were up today. Radio stocks. And then about 6 years later,
Disappeared.
disappeared.
Yeah.
because all these technologies get absorbed. And this is where these risk tolerance questionnaires can, I think, help you, the better ones, when you're in times of exuberance. And frankly, that is where we are. And that is all we have got for financial fitness with the overconfident Jonathan McCarty, whose assignment when he gets home is to find Hee-Haw on YouTube, because he did not know.
Missing out on the classics.
But he did know the Munsters. And I think that's, overall, we're going to give him a pass because of that. And we appreciate you being here with us for Financial Fitness. We'll see you again next week.
Happy Halloween.